welcome to everyone. My name is Omar Aru and I'm the Regional Manager for the Western Cape. This is our second PPSI Think Tank series for the Western Cape. Our theme for today is unpacking our investment process at PPS Investments. Our guest speaker for today is Andre Tron, who is the head of our research team. Please feel free to post questions in the chat box during the course of the presentation, and then we'll deal with them at the end of the presentation. So without any further ado, over to Andre. Thanks, Andre.
Good morning, everyone, and thank you for joining us this morning. As Almaro mentioned, I'm the head of research, and I'm ultimately responsible for the integrity and robustness of our research capability and for managing the team. Now, before I dive into our research process, I just want to take a couple of minutes to set the scene. Roughly 50 years after the first unit trust was launched in South Africa, investors now have more than 1,500 funds to choose from. This is significantly more than the number of companies available on the JSE or listed on the JSE. In only 5 years, the number of funds available to investors have increased by 50%. Unit trusts were initially introduced to make investing in the financial markets easier. Ironically, with so many different options to choose from, investors are now faced with an even greater challenge of filtering through this massive universe in order to select a fund that meets their needs. So how effective is it to choose funds based on recent performance delivered? The fund ranking table on the slide shows just how variable the relative returns of asset managers are over the short term. Each color represents one of the largest equity funds in South Africa, while each column represents a relative ranking of the managers in each calendar year. We can see from the random distribution of colors that it's indeed impossible to predict with any confidence who the best performing manager will be by purely looking at recent performance. Now, even with this in mind, numerous studies have shown that investors often react irrationally and make poor investment decisions when disappointed by their own short-term returns. Fidelity Investments conducted a study on its flagship fund managed by the famous Peter Lynch from 1977 to 1990. Over this 13-year period, the fund delivered an average return of 29% per year. The study found that the average investor over this period actually lost money, despite the phenomenal returns delivered by the fund. They concluded that the main reason for poor performance achieved by the average investor in the fund was a tendency to withdraw from the fund during periods of poor performance, only to reallocate capital to the fund after periods of success. It is also Peter Lynch who said that the trick is not to learn to trust your gut feelings, but to rather discipline yourself to ignore them. Stand by your stocks as long as the fundamental story of the company hasn't changed. The same is also true for fund selection. So we take emotion out of the equation by following a clearly defined, well-disciplined, and research-intensive process. Here, I show the 5 aspects of our investment process. Today, I will focus on the first 3 aspects of our process that deal with screening, manager selection, and manager blending. So we continuously screen the entire investable universe to ensure that we are not missing managers that could offer something different or interesting, and eliminate managers that do not meet our minimum requirements. We have a backward-looking screening tool that identifies managers with a favorable return profile relative to a stated benchmark. For specialist funds, we measure the performance relative to the asset class index, while we use the CISA peer group average as the benchmark for multi-asset funds. We also attend many conferences and investment forums where we get exposure to different manager strategies. And it's at engagements like these where we look to identify up and coming managers to monitor. We also conduct full category reviews on a monthly basis, where we utilize different quantitative tools to slice and dice the universe of managers in different ways and over various periods to highlight strategies for consideration. Once we formally assess the strategy, we assign a list status to the fund. The list status of the fund will drive future engagements, forcing a reassessment of the fund within a predetermined period. Our process is designed to combine the results from rigorous number crunching with the emphasis on providing context for the performance delivered in the past, with insights gained from meetings with the key decision makers of the portfolio under their review. This is an iterative and ongoing process. Understanding the environment in which the performance was delivered and scrutinizing the underlying positions included in the portfolio through time form the basis of our quantitative analysis. For this exercise, we perform various holdings and return-based analyses over multiple time periods. Here, I show a couple of the tools we use as part of our assessment. The charts on your left and top right form part of our clustering tools. The aim of these tools is to group funds based on similarities of either the excess returns delivered or exposure to various components or factors. Additionally, the quant is used to test our assumptions and to see if what the manager is telling us in terms of their investment approach is actually reflected in the performance profile and positioning of the fund. Now, the qualitative aspect of our process is more subjective by its nature. And in our engagements with asset managers, we interrogate the managers on various aspects of their business, the team, and their investment strategy that could impact performance going forward. The things we typically consider include ownership structure, transformation, depth and breadth of team dynamics, fund turnover, risk management, and the ability to express their views, to name a few. The aim is to determine whether the structure of the organization, the expertise of the broader investment team, and the interaction with the key decision makers, as well as the way investments or investment ideas are generated and included in the fund, are conducive to generating strong future returns. Now, every engagement will result in a research report that is submitted to the team for discussion. We have a weekly meeting on Thursdays where we debate the ratings and formalize our views on the funds. In our assessments, we assign a rating for each of our three fundamental pillars, namely the organizational structure and stability, people and support, and investment approach. The rating varies from 1 to 4, with 4 indicating an extremely high confidence that the pillar is supportive of delivering strong future returns. These ratings ultimately reflect our fundamental view on the fund. And as long as all the pillars are rated a 3 or a 4, we should continue to back the fund, irrespective of its recent performance. Now, just to be clear, it is not that we completely ignore the short-term performance delivered by the fund, but the emphasis is rather on assessing whether the performance delivered was in line with our expectations. Now, for this particular fund shown on the slide, which by the way is one of the strategies in the PPS equity fund, you can see that we've met with the portfolio manager 8 times over the last 4-year period. Given that this is a buy list fund, our process requires us to meet with the manager at least twice a year. We have made rating changes on organizational pillar in 2018 and the people and support pillar in 2019 as the underlying circumstances changed. Now, as a multi-manager, we spend most of our time analyzing asset managers to gain confidence in their ability to generate superior future returns. In calendar year 2020, we had more than 200 engagements with the key decision makers of the funds. As mentioned earlier in the presentation, we do not only focus on strategies already included in our funds or on our buy list. You can see that the bulk of our engagements were actually on strategies not on our buy list. More importantly, these engagements were spread across roughly 160 strategies and 76 different asset managers. Now, after conducting all these assessments, we end up with a list of managers, our buy list, with strong ratings across all three our fundamental pillars. We also have a good understanding of the environment in which past performance was delivered. And we also have a sense of what to expect from the manager going forward. The next step in the process is to combine the funds. Manager blending is all about combining different but complementary manager strategies. The aim is to include managers that think differently about the world, and as a result is expected to perform in different environments. This should result in a much smoother return profile over time. Here I show our events analysis, which is only one of the many tools we use as part of our manager blending process. As part of the research, we've identified a number of global and local shock events over the past 15 to 20 years that either had a material impact on market returns, such as the 2008-2009 global financial crisis, the COVID sell-off and subsequent recovery, or that have resulted in a wide dispersion in returns within categories. On this slide, I specifically focus on the SA-specific shock events and include events such as Nenegate, relevant for any fund with banking or fixed interest exposure, Ramaphoria, where we saw strong performance from SA Inc. stocks on the back of Cyril Ramaphosa winning the presidential election, and the 2017 Naspers rally. Here I only show our buy list equity managers, and it's already clear to see the disproportionate impact some of these events had on relative returns. Now, this not only helps us to better understand the key drivers of returns, but also provide greater insight into the relative positioning of funds within the same category. Now, I gave you some insight into our process and shared with you some of the tools we use on a daily basis. But our biggest competitive advantage is our team. As part of our process, we meet a lot of asset management teams. We therefore have the benefit of seeing what works well and what is causing problems within an investment team environment. We have a diverse team of experienced and highly qualified investment professionals, but this alone is not enough. To ensure that we effectively debate topics and challenge our own beliefs and biases, we work hard to create an inclusive environment. Only in such an environment will we be able to get the real benefits of having a diverse team. Given that manager research is key to our investment approach, every member of the team, from the CIO to the most junior research analyst, conduct asset manager research, ensuring different perspectives are considered. So let's look at the performance of our solutions to see if all of this work is delivering the desired results. I show our multi-managed funds at the top and our more recently launched partnership range at the bottom. Now, the fact that you're seeing a lot of green is already a good sign. So even though we've delivered strong returns over the short time periods, we are particularly proud of the solid long-term track records of our solutions. Okay, so we do have some time for Q&A, and I thought it'll be more useful to answer your questions. So I'll hand back to the BD team to take your questions. Thank you.
The first question from Hassan was, Andriette, do you also look at ETF managers to include ETFs within your funds or within our funds?
We currently don't look at ETFs. We do look at passive investments, but I mean, we don't currently allocate to ETFs specifically, just from an operational point of view. We don't look at that, but we do include passive funds. So it's not just active managers that's included in our solutions.
Perfect, thank you. The second question from Hassan is, do you as PPS approach managers, or do you entertain managers who might approach you to consider their funds?
We do both. So basically, I mean, through our process, we, as I mentioned, we're forced to engage with managers and re-engage, even though they, we don't necessarily have a favorable view on their ratings. But so yes, we engage with managers, we will reach out to them, but we also are happy to engage with managers that want to discuss their strategies. I mean, we will obviously, before we engage with the managers, we will consider just track record, their offering, their size. I mean, there's minimum criteria that we look for, but I mean, we're always happy to engage with managers.
Okay, thank you for that. The third question, and feel free anyone to just post any more questions. The third question here is, your process still relies heavily on past returns and data. If a manager doesn't do what they say they do, how long does it take for us or to remove them from the portfolio? So does it ever happen? Do we have examples of that? And then how often does it happen and how long does it take for us to remove them?
Okay, so yes, it definitely does happen. So, but I mean, I think the first point is that our process helps us not to react to short-term performance. So we generally identify these potential issues well before it's reflected in the returns. So once we've identified this issue or potential issue, we will do further analysis and then have multiple engagements with the manager to discuss the issues. So once we've reached a point that we no longer believe that the affected pillar is supportive of delivering superior future returns, we will act very quickly and start the process of exiting managers. So, I mean, we typically want to invest for the long term. That's our aim. But I mean, obviously, I mean, given that, let's say if a fund is in, a manager's in our fund, as I mentioned on a buy-list fund, we engage with them twice a year. So we have a lot of opportunity, and it's not just twice a year. I mean, we monitor the manager on a monthly basis, the holdings, the positioning, or the performance. So, so once we've reached a point that the pillar is not supportive, I mean, we will start the process and exit the manager. And the other reason why we'll exit the manager is maybe just from a portfolio construction point of view, is where we want to bring in a different dynamic or manager into the fund.
Perfect, thank you. Just the last question I have here is, when we pick a new manager, are there times that the manager size is too big or too small? So do we have size constraints? Obviously, when we pick funds, do we place limits on terms of how big the AUM is?
Yes, so we do have minimum thresholds in terms of fund size and AUM. I think the important thing to note is that it does not mean that we will only start to engage with the manager once they meet our internal limits. So, I mean, it takes time to get to know a manager and to really understand their strategy. So, but yes, we will only consider a manager for or a fund for the buy list once they meet our minimum requirements.
How do you determine how much a fund manager will receive?
Okay, so I mean, in our portfolio construction process, we like to give managers chunky positions in our fund. So I mean, if you take our equity fund, for example, we only have 3 managers in the equity fund. We don't believe that an equity fund, I mean, I know that there's an argument that people want to include more managers, but we like chunky positions. So we want the manager to have a meaningful allocation in the fund. So I mean, our allocations to managers tend to be fairly large, and that's also why we have limits on AUM, so that, I mean, we don't want to dominate their assets or their book as well. So is that answering the first question?
Yeah, that first question is
okay.
sorted. The second part of it is, what do you do to bring down the costs of the fund managers?
Because obviously, I mean, if we allocate, I mean, as I mentioned, have these chunky allocations and large allocations to manager, we do negotiate the fees. So we do get quite favorable fees and institutional fees. And on our solutions, that's on a cost plus basis, then obviously, I mean, that benefit is passed on to clients directly. So we, yeah, I mean, and we also have fee budgets as an example that where we have limits in terms of how much we are willing to pay for a manager. And it's also, I mean, depending on the strategy. So obviously we look at the individual mandates as well, because obviously, I mean, different strategies will have different ranges, or in terms of how much we're willing to pay for that strategy. And typically in performance fees, we don't prefer for performance fee. I mean, all our solutions are available in the tax-free savings account. So we like to, or we prefer flat fees.
Just on that performance fee, and I'll add on there, if a fund only charges performance fees, based on our size, do you think that we're able to kind of negotiate a good flat fee? Are funds willing to kind of drop their performance fee to kind of have us use their solution?
Yes, in most cases, we've been able to get managers to give us a favorable flat fee. So, I mean, the performance fee, I mean, the flat fee, the starting point in the flat fee is essentially the average of the performance fee through time. So, I mean, if it's symmetrical, but we know it's not. So it's like, so given our size, again, managers are very willing to negotiate fees with us.
Perfect. Hassan's asked another question. With your partnership fund range, since you have a specific partnership with a particular manager, do you follow a similar approach in terms of exiting a manager if they are not performing? He's given an example. He said, if SASFIN is not performing according to what your mandate requires over time.
Yes, so I mean, the partnership range is managed, we run them through exactly the same process. So again, we have the 3 pillars. We look at exactly the pillars, but obviously the partnership range is slightly different to, I mean, we don't follow the manager combination part of the process. So we do look at it. I mean, I think with SASFIN specifically, I know when we launched the partnership range, they went through a period of underperformance that was mainly driven by their positioning. They had quite a lot of ILBs, they had quite a low international equity exposure, the rand weakened, so they didn't benefit to the same extent as some of their peers. We understood the positioning. We had many engagements with the managers in terms, or with Errol Shear in terms of the positioning, his views. I mean, and then, I mean, we saw now recently that positioning actually benefited the fund, and the fund is doing well now. So I think that's a good example of where we noticed the short-term performance, we engaged, we did our analysis, and we were happy that the manager is continuing to invest the fund according to his approach, which obviously is got a 20-year track record of managing multi-asset low funds in the same way. And we were happy that the manager can still deliver the objective of our fund over the long term. But yes, I mean, we monitor, it's exactly the same. It's seen as a buy-list manager. We engage with the manager at least twice a year. So if there's fundamental issues, we will replace the manager.
Fantastic. And then the last question from Vanna is, are the asset manager fees charged to us generally less what they offer directly to public investors? So obviously, let's just use an example, 91, for instance. If you go directly to 91 and invest in their solution versus coming through our equity fund, you know, or kind of any of our solutions, would the asset manager fee be generally cheaper? I think you've answered that as well.
Yes, it will. I mean, we do get institutional fees based on so we typically go on a sliding scale. So, I mean, we definitely, as we allocate more money to the manager as well, I mean, the benefits of the fee will be passed on to the client, or the fee will be lower.
Perfect. I don't see any more questions. Let me check the last Q&A. There's no questions there. Over to you, Almaru.
Just a comment from Hassan. Thank you very much for the session.
Great.
Thank you very much, Andre. Thank you for the useful information regarding how we're going about selecting managers. Thanks, John, for answering the questions. And please look out for our next invite for the PPSI Think Tank series for the Western Cape. We will be sending out the next invites in the next 2 weeks for the next session. But thanks, Andre. Thanks, John. And you almost have a lovely day. Thank you very much.